Good afternoon and happy Friday. This is Markets for Millennials, and this is the weekly analysis from September 12th through September 16th. And this week's analysis is called Sticky Inflation Smashes the Markets. And obviously, the big story of the week was that inflation rose 0.1% in August, even with a sharp drop in gas prices. And that doesn't even really tell the whole story. Obviously, if you head down and you check out in all of the news the core CPI, that it actually rose 0.6% and year over year 6.3%. That's not like both metrics were actually above what was expected, and that's why the markets reacted the way that they did, and that's the reason why I called this sticky inflation. And so I just want to take a look at the some market data really quick. So I've got the left column highlighted, and I have a couple of different metrics here. I have the year-over-year metrics for both consumer price year-over-year and core CPI, and but I also have the month-over-month, right? 0.1 in the headline inflation, 0.6 in the core CPI month-over-month. And what you really start to notice, what you have to start looking at now is, I mean, if inflation will have peaked in the sense potentially of the year-over-year numbers. So the fact that these numbers are going down, at least on the headline level, shouldn't really be that big of a deal anymore. But what was interesting was the core CPI level actually kicked up, even though headline came down on the year-over-year numbers. And what we have to pay attention to is what is the rate of change and what does inflation look like on an annualized basis, both looking at the 1 month annualized, 2 month, and the 3 month annualized rates. And so everybody could potentially look at these the headline numbers and look and see that there's cause for celebration. I mean, if you obviously, if you annualize the July report, then that would be zero inflation. If you annualize this report, it's 1.2, which seems really great. And then obviously you see a similar reduction when it comes to the 2 month annualized, down from the last couple of months, as well as the 3 month annualized. But then what really matters is the core inflation, because you take away food and energy, and that's the metric you would want to go off of. And when you look at the annualized, we're actually higher than last month. And the rate of change between the previous report and this report has slowed a bit on the 2 month. And then on the 3 month annualized, we're at the same level. And so what this is showing you is that the inflation is stickier. And I don't have off the top of I don't have the data of looking at median CPI, sticky CPI, and trimmed median CPI. I don't have those numbers to show you. There are others in FinTwit who can share those numbers with you. But I wanted to show you those because those things have had, because what you want is to see these continuing to drop, and the fact that this doesn't shows you that even though fuel prices are coming down, that inflation is going to be stickier. We also had the producer price index come in, and you can again see the decline on the headline level. You also do see a decline on the core level. However, we have held steady on producer prices month over month for the last few months, and if you annualize that, then that's obviously in the upper fours level, and obviously you want that to come down. So another report that we just had today was consumer sentiment, and so consumer sentiment actually edged higher. It didn't. This is not a free article. The consumer sentiment was up, but it was not up as much as it had been estimated to be, and right now the market is worried, although consumer expectations expect this are starting to be really concerned about this expectation of sticky inflation. However, I don't have the article up right now, but there is also discussion about the fact that inflation expectations on a 5-year basis are down. They came down versus last month, and I think that's part of the reason why you got this kind of market reaction today, because if you actually go to, let's do a 5-minute chart here on the S&P, because going into the consumer sentiment and the metrics from University of Michigan today, you just kind of see the market kind of coming off at an accelerated rate. And then as soon as 7 o'clock rolls around, that's when we got the initial bounce. We sold it off and kind of collected at the bottom around the same levels. The NASDAQ was down a little over 200 points at one point today. And then as the market continued to digest that information, we got this rise up. And so that's just to kind of show you what the price action looked like throughout the day. However, the other thing, and I don't have it pulled up, maybe I can get to it really quickly on my Twitter account. I don't know, I apologize, I'm trying to do this in real time. Excuse me a second while I talk about this. But basically, I had posted this today. Lots of people are going to be really excited on the close today because I was watching the price action. Let me go back to my 5-minute. I was watching this price action start to come up, and I was noticing that, or I was thinking that what was going to happen was because of the depth of the fall. And again, if I jump back to the daily chart, you can see how deep this wick was down, that a lot of people will see the price action toward the end of the day. And I thought, okay, well, people are going to get excited and they're going to talk about how it's bullish because it means that that the price pressures can't keep the S&P down. A lot of people are going to look at how we still haven't made lower lows, and I even was hearing people on various podcasts and sites talking about how they're surprised that the market still is holding up pretty well. And I mean, like, we had this huge dump. I mean, how much selling do you expect? Kind of my position is, how much selling do you expect? And in one day particularly, and we're still down even from there. So I mean, on the week, if you want to take a look at the weekly chart, we've engulfed last week where we had these huge gains. We dropped about 4.5% on the S&P. We dropped over 5.5% on the NASDAQ. And actually, just to give you some perspective, on the NASDAQ specifically, this drop was over 700 points, and you have to go all the way back to the March 2020 crash, and it might have, it was in March, I believe. You have to go to the March 2020 crash on March 12th, and then on March 16th for the last time that the NASDAQ drops at least 700 points in a day. It didn't do that anywhere else all along the way. We got pretty close here in September of 2020 on one occasion, September 3rd. But never really was close at any other point to making that substantial a drop at any point. And that includes these various drops along the way since we peaked at the beginning of 2022. So things don't look bullish. I mean, even though people are reading this as, oh, this is, bullish because the, price is telling you that the market doesn't want to go down any further. Peak fear is already being priced in. But another factor that I posted here, to go back to my tweet, was that options expiry. This is triple witching day because it's September, so we're in the last month of the quarter, and we're in OPEX for the month of September, and so we get weekly and quarterly, and I forget the other one, weekly, monthly, and quarterly options expiration all at the same time. That's why it's called triple witching. And the pin, the gamma pin, I believe it's called gamma pin. I'm trying to remember my terms here, thinking in real time. But the pin for price today was 3,900, and that's what I posted about. And so I just, after the market closed, I posted this just saying LOL, LOL, because look at where we pinned, and that's where we are today. If you look on the right side of the screen, we pinned we closed at 39.02. So it's not surprising to me that the options that the price were retraced into the close, and I just want to show you here the technical damage that's been done. I made a big deal out of how price didn't break support right there. This was a crucial line in the sand, and I held I was holding at the time, and I still hold that if we broke this support, that we were going to retest the lows. I still think we will, and We got obviously some super duper solid price action last week, but we, on the inflation numbers, gave most of it back, and then we have since retraced the whole move. And so we have done significant technical damage from the standpoint of our support trend line, and then also from where I was marking horizontal support, which is now turned into resistance. And obviously, you can make the case that, well, we closed below it already. But even if I make that adjustment, let me turn the magnet on for a second. Even if I make that adjustment, we closed below. I mean, we opened below it and still didn't manage to get back above it. So that doesn't look good. I like the line better right there. So I'm going to leave it there. That does not look good. And so I'm expecting continuation to the downside. Going into next week, especially as options repositioning starts to take place and new positions begin to be established. And so I think this is a classic scenario where, first week after Labor Day of trading, we get this bullish price action to the upside. Everybody thinks, oh, yeah, the positions are being established for the fall, and it looks like we're going to head all the way back up. And actually, in my opinion now, this stands to at least retest the lows, if not make lower lows, in my opinion. On the NASDAQ, we kind of have the same story, although obviously the support was quite a bit different. On this channel, I've been tracing this a little bit. I had the trend line there. Now, as I look at price, it looks like the trend line should have been right there, which I did have it there at one point. And you can see we actually got a perfect breakdown and then a retest, and then we have resumed down. So I'm expecting the price action to continue to the downside, and I am also waiting on. I put this trend line. Let me just say that because we've made a lower low. Again, the rules for making a trend line is once you. So the trend line was there at first, and then once you break it and then make a lower low, you adjust it just like that. And then I'll be watching to see if we make the lower low compared to June, because if we do, then I'm going to be taking the trend line right here and putting it right there instead of where it used to be, which was right here. Again, that's the rules. You have to be able to follow kind of some rules in order to not make it too much up to your opinion when you're doing TA. On the Dow, also not looking good. We're actually getting pretty close we're about $1,200 away from the lows that we had put in back in June. So it's looking pretty weak. And I did the same kind of thing there. I'm just waiting for the lower low up here to adjust this trend line to the top of this wick. So I'm expecting follow through there as well. The only one that's kind of not confirming, and I've talked about this in the past before, especially when we were talking about this breakout on the Russell back in 2021 and then the eventual collapse to the downside. And even, as you know, on this channel, I covered the Russell really well across most of 2021, asking the question, well, why is the Russell lagging? Why is it not outperforming? And in this case, I'm going to talk about it to the other direction. And the reason why is, as you look, we are still above support. I talked about this last week, that from our descending trend line, we broke out and we came in for a retest. And we've retested that perfectly. And now what we're concerned about is, will this support, this underside support, will that line hold? It looks like we did hold for today. Are we going to end up breaking this and kind of bouncing along here and then fall down? Or are we going to hold this and move back up? Are we going to break down to this trend line and then bounce back up and then get rejected around this trend line? Anything could really happen, but those are definitely the levels that you want to pay attention to. You can also see I have this kind of horizontal level of support, which it's not a super strong level. It kind of goes back to November 2020. It proved to be resistance over here and then support as you follow my mouse across the screen. And so I am watching that as well. And so these are your levels to manage your risk around. If you are if you think this is the bottom, or if you think we have already, I should say, made the bottom, then a good risk to reward position on the long side is going to be to place a stop loss right about there, below the wick, below the support, below the trend line. Or if you're feeling like you want to give yourself a little bit more room, putting the stop loss right about there gives you a little bit of room, but obviously that changes the risk reward. And so that's kind of the levels you want to watch. We'll take a look at the dollar. A lot of people celebrating today because, or these last couple of days, because the dollar hasn't, again, made a new high. Had a massive move on the CPI release day. And the way that I look at this, I mean, you guys know I tend to look at things based on the strength and momentum. And right now, the momentum is up, but the strength is lagging a little bit. And so the question is, are we rippling here between bullish and neutral because the strength underneath the dollar is waning and it's eventually going to turn, or is it just gathering steam for the next move? And it's not really oversold, but you do notice that the volatility range is coming in a little bit, and so I'm expecting some more big moves, because as you look back across just the last year, that whenever the volatility range started to squeeze together, we got either a very long bullish move, or we got an explosive move. And so that's going to be the next thing that I'm watching. You'll notice too, I have this little yellow arrow pointing down, or this yellow triangle pointing down at the bottom. Usually what that signals is that the near-term strength and momentum is trying to, in terms of volatility, is trying to push the other direction, kind of a counter trend situation. And so when you start to see that in a trending market, and this is a trending market, when you start to see that, that indicates that if you're looking for a good place to take a long position, at least in this case, this is a good spot to set up your position. And so I can remove this for a second. I just show you the risk management here. Obviously, you've missed out on this at this point. You've missed out on a lot of price action to the upside, especially if you've been one of the ones calling tops at all of the different places, like calling tops there, and there, and there, and there, and there, and there, and there. So, I mean, but I digress. But if you do want a good spot that you can set your risk at, and that would be right here. Right below the start of this really big green candle. And obviously, again, what you should be doing is trying to take positions in which you can manage your risk really well. And again, this is where I don't know if any of you are trading the dollar. I don't ever trade the dollar itself. I trade or the DXY. I always trade the currency pairs. But this is kind of the spot. If you're going to go long on U.S. dollar pairs, or in favor of the U.S. dollar, then this is the spot to watch. If price falls below this, then you want to start getting out of those positions. And then you also want to watch the ascending trend line right here, because you can see that price, as it's come closer to it, it has provided good support. And then another good place to watch is the 50-day moving average, because it has provided the place to lean in on this move to the upside. So just something to be aware of. I wanted to point out quickly the Treasury yields, because Treasury yields are following a very narrow pathway. In fact, if you want to, you can try this out sometime. If you want to take a regression channel and put it to from the start of this move, it's a really tight range. It's a very tightly trending market, the Treasury yields, and that's something definitely to watch. This is going to be the first trend line that will show if we are going to get a breakdown here. What'll really be a big deal next week is the FOMC meeting, because if they come out with another 75 basis point hike, or potentially more, I don't know. The market right now is not pricing in at 100 basis points, it's pricing in 75, but a lot of people are concerned about that. But if we do get a hawkish stance, then you should expect the bond yields to get a considerable move up. And actually, if you go to the U.S. 2-year Treasury yield, excuse me a second while I try to get this fixed here. I have my searches all weird. you've got to move really close to 4% already in the 2-year Treasury yield. And then when you go check out the yield curves, the yield curve is still extremely inverted, and it looks like it's bear flagging right here, which is pretty crazy if you think about it. But in any case, if you are hoping for relief for the markets, then you're hoping for this to be a double top, because we are right at just about the levels that we were at back in June when at the market lows. So again, like what's really interesting is like we're at the same levels that we were when we hit the lows in June, and yet on the we still haven't. I mean, we're at a what is this, a 50% retrace from the low to the peak. Okay, about a 618, and we actually broke below the 618. That was where we got a little bit of a bounce, which is really interesting to notice, but because I hadn't been looking at that prior to this moment. But that is something to pay attention to. And so either bonds are going to come off or the market is going to keep repricing to the downside. Let's take a look at gold. Gold's an ugly chart. Gold broke below its multi-year lows. We haven't been at this level since, well, when was the last time we were at this level? Yeah, the last time we closed to these levels previously was back in 2020, shortly after the crisis started and right before gold ran up to over 2,000. And what's concerning about that is now we're coming for the underside retest of those lows. And so I think that we're in a channel right now, and a lot of people wondering why gold isn't doing well, especially with geopolitical uncertainty, especially in an inflationary environment. And the answer ultimately is that the market is actually still pricing in growth. And that's probably part of the reason why equities haven't crashed as much as they probably could have, because when the market is when the market is pricing in growth, whether it's slow or rapid growth, gold doesn't really perform well. It's only when it's only when growth comes off and is stagnant or potentially even to the downside, that's when you see gold outperforming, unless we go into a deflationary event, in which case gold is going to get destroyed. And so I've been talking lately, either the market is continuing to price in the possibility of Goldilocks and growth, continued growth, or the market is telling you that we're about ready to go into our one-to-one correlation, like crash type of situation. And I have no bias either way. I personally am expecting lower lows, but that's just my bias, but I just have to be aware of what the charts are saying. Crude oil got a little bit of a bounce over the last week and a half, sold off pretty hard yesterday, but we have not made a lower low from last week, so that's something to watch. That was that day after, or a couple days after Labor Day situation. I'm still watching in oil this trend line right here. We'll see if this trend line matters, if we get a break above it or not. It looks like for now, I mean, unless something changes, it looks like this support may hold. I don't know what just happened to my chart. Oh, there we go. We'll see if this like multi-layered bit of support holds in the long run, and if we can get a breakout from that. But right now, oil is still, even on my strength and momentum signal, it's still showing pretty substantially bearish, with counter trend moves to the upside. And so if you're looking to sell oil, my SAMS indicator is suggesting this is an opportunity to lay some short positions. But also, I mean, you've missed a lot of the price action. Oil's down over 30%. So I don't know if it's worth chasing to the downside any further. Just my opinion. And then Bitcoin, I was looking at the futures. Bitcoin coming off pretty hard. The downtrend is significant, and haven't yet made new lows. We did make that closing low I mentioned before we got that huge move last week. We have almost given all of it back, so we'll see what happens this weekend. You should watch Bitcoin over the weekend to kind of get an indication of where the markets are going to go, starting on when the futures markets open Sunday evening and then into Monday morning. So that's kind of the look today. Again, the inflation really crashed the party and kicked the markets in the midsection, if you know what I'm saying. And so right now the markets are hinging once again. If you go by the S&P and NASDAQ, they're breaking down, ready to revisit the lows. Really, the Russell is where, kind of like I said, as far as confirmations go, I'm holding out. And so you want to trade wisely. You want to be prepared for as many possibilities as possible. Even if you are bearish, you do not want to lean 100% bearish, because if you try to short the market, you can get destroyed if the market bounces. And many people, and myself included in some ways, learned that here, and many people, learned it over here too. I know I'm looking at the Russell. I should look at the NASDAQ for bounces. So a lot of people learn that here and here. You have to be really careful about how you position. So you have to position for multiple outcomes, and even if some of your trades go against you, the point is to work things in such a way that the trades that go against you won't hurt you as much as the trades that go in your favor. And so obviously you want to learn how to do that. Anyway, that's the weekly analysis for this week. Thank you for tuning in. Make sure you hit the like button, and make sure you subscribe to the channel and share it with somebody if you think they'll find it important. And thanks for watching. I'll see you guys next time.